So we're going to be working on Pitch Company, and we're going to be doing 2 years, and we're given some data, some things are missing, and we have a pension worksheet over here, and we're going to be completing it. And this exercise presumes that you've already had some practice, you've already had the lecture, you've already done some prior work, and so this is just a way to wrap it up and cumulatively touch all the major parts. All right, so the first thing we want to do is put the opening balances in these various accounts. This is the employer's books. We don't know what cash activity is, but we're putting it in here just so all of our activity, the debits and credits, balance out. Pension expense would be 0 at the beginning of the year because it's always closed out to retained earnings, just like all revenues and expenses are. OCI, prior service cost. Let's see, do they have it? They do, 160, so let's put that in there. That will be a debit. Prior service cost is always a debit. OCI, gains or losses. They don't have any. All right, so that's 0 to start with. Okay, and then let's go over here, plan assets. They give us 410, and then beginning obligations. That's a credit, so as you can see from the top, debits are without brackets, credits are with brackets. Okay, so we have a situation where the assets are bigger than the liabilities. So that means that there'll be an asset reflected on the employer's books for that overfunding of the pension obligation at the beginning of the year. All right, so now we can start working on pension expense and any other adjustments that might need to be made. So we have service cost, $42,000 in year 4. Okay, so service cost is going to increase pension expense. And it's going to increase the liability. And it's going to increase the obligation. Whoops, that's not where I meant for it to go. We've gone from a net asset to a net liability here. We'll be adding this up in a little bit. Okay, what about interest cost for the year? So they tell you the settlement rate. That's the same as the discount rate. That is not the return on assets. This is the rate used to discount future payments back to the present. The return on assets is a separate percent here. So for the interest cost, we're going to use this settlement or discount rate. So the interest cost will be the obligation at the beginning of the year times this rate. Whoops. All right, so the obligation goes up because you're 1 year closer to retirement. That's what the interest cost is. Okay, so now the return on assets. We have an actual return of $14,000 and an expected return of 6% of beginning assets being the 410. All right, so let's put that in here. So the plan assets are going up by the actual return because the plan doesn't pay any attention to the smoothing that the employer does. But the employer is going to reduce this pension expense by the expected return on assets, which is the 410 times that expected rate. And so then the difference between these two is going to get spooled up in OCI. I'm showing it here on 2 lines. Some worksheets have it on 1 line, which is fine, and then they just put the net in this column, which is fine. So if one of them is more intuitive for you, they both work. They both will give you the correct net of 10,600, as a unexpected loss in other gains and losses, OCI, related to pensions. Okay, so let's get this in here. Other side of the entry. Oh, excuse me, we don't need to do that one because that one is already only on the employer's books and not something that the pension plan pays attention to. The pension plan only does the 14,000, and of course that increases the now amortizing the prior service costs. So we do have prior service costs in OCI, and they tell us, I thought I saw it here, how much to amortize, 70,000. All right, so what that means is I'm going to remove the 70,000 from other comprehensive income, so a section of equity, and I'm going to expense that into pension expense in the current year. And that is not something happening over here on the pension books. They don't, when the change in contract occurs and the obligation changes, the obligation is just updated on the pension books. But it's smoothed into pension expense over many years because GAAP permits that. All right, and then there would be a payment for the contributions, payment to the pension expense, contributions to the plan. That would increase their assets. All right, then we've got some payments. Payments reduce the assets and the obligation on the employer's books, on the pension plan books, but nothing happens on the employer's books for that. And there's no change to the net assets for that either. All right, were there any assumption changes? Yes. Okay, so let's get that in here. So the assumption change is a change to the obligation because some of the variables used to forecast out the obligation have shifted. So something that impacts the lifespan of your workers, or how many are staying until their vesting date, the amount of turnover, and that sort of thing. So we have sort of an unexpected loss here. I think that's what the number was. I guess I shouldn't key in. I should point and let me point. Okay, there we go. It could be unexpected gain depending on whether it increases or decreases the expected payout during the retirement years. So we have an increase in the obligation due to the change in some variables in the model that the actuary is using. And then there can't be a corridor effect for year 4. Why not? Because the beginning OCI gain or loss is 0. And the corridor test is done against beginning gain or loss to see if that balance has gotten so large that it's larger than the bigger of the 10% of the plan assets or plan liabilities. Well, the plan asset and plan liabilities are in the 40,000 range, so 10% of that, the 400,000 range, 10% of that would be 40,000. Well, 0 is nowhere near 40,000. And so the corridor, if you get above the corridor, so in this case above 40,000, you'd have to shave whatever amount above 40,000 there was. Well, there's nothing above anything here at 0. Now next year there may in fact be one, and we'll have to test for it. All right, let's do the math and get the balances at the end of year 4. Oh, this needs to be a debit. Okay. So it reduces the liability, reduces the asset, but we reduce the liability with the debit, so I had that in there incorrectly. Okay, so now this ending year 4 becomes the beginning year 5. All right, so let's start the pattern again. And if you're feeling comfortable, you may want to freeze the frame and work year 5 on your own and then come back and check it. All right, so service cost for year 5. And the interest cost for year 5 is going to be beginning obligation times the settlement or discount rate, which is still at 6%. All right, so let's complete this grid here for those. Notice that these are actual journal entries, right? Debit to pension expense, credit to asset liability, debit to pension expense, credit to asset liability. So even though they're in this worksheet format, they are journal entries on the employer's books. All right, the actual return is that 71, so that's going to go into the pension assets. And then the expected return is going to be offsetting pension expense, and that's going to be beginning assets times the expected return on asset rate. Did I do interest expense times that 6%? I sure did. Let's fix that. You probably noticed that. So that's fixed. All right. All right, let's complete these here. And that's going to go into OCI. Of course, you can do this as one line, netting the minus 40 to 20, if you like. All right, amortizing the prior service costs, so they give us that. There we go. And that's going to go into pension expense and additional pension expense contributions. It's going to be a reduction to cash. And to the asset liability account. And then it's coming into assets. Benefits paid is going to be a credit against the assets. That's a pretty big difference in benefits paid. And then a debit to liability, and then there's no change to net assets for that. There were no assumption changes in year 5, and there don't have to be. This grid just has a space for every possible thing, so that doesn't mean that there is one. All right, so now let's test this gain or loss corridor. So the beginning is 90,600, and we're going to check to see if that is bigger than the larger of plan assets or plan benefit obligations. So the benefit obligation is bigger, 550,000, and 10% of that. And then the beginning OCI, 90,600. All right, so we have to amortize everything over that 55. So that's the amount outside the corridor that's permitted. The average service life is 16, and so we will amortize 1/16 of the stuff that's over the 10%. So we're going to amortize, we're going to reduce out of OCI and into pension expense, either a debit or a credit, depends on which side the big thing is. So we're going to take that 225 out. So it's a debit right now, so we're going to credit it. And add that to pension expense. Notice that that doesn't do anything over here because the pension recorded the actuals and not the estimated. So none of this, some of it being trapped in equity, is going on the pension books. All right, let's try the math then. Remember, except for the expense account, remember to include in your math the beginning balance, which is last year's ending balance. So then they want to know what is the pension expense and the other items that are going to be reported on the financial statement for year 5. So pension expense is going to be that amount that we've calculated. Unrealized pension gains or losses that are in other comprehensive income. So this is the portion after the income statement that records just this year's increment. So this is not the cumulative amount that's in the balance sheet in the equity section that's coming down here. This is just this year's shift. And so this year's shift is going to be the change in the OCI. And then the amortization of the prior service costs, what was the change, and then the amortization of the gain or loss. And then pension asset won't have anything. There'll be a pension obligation because at the end of the year, the obligation is greater than the assets. And so that will be a pension liability. And then the cumulative OCI pension losses is that ending here. I don't know why there's not a spot here for the prior service cost, but there should be. There we go. So those are your balance sheet amounts that would be reported based on this. So I will be doing another one that's very similar to this. I'll be posting it in D2L. Work it on your own and then walk through the video and check your work.